Good morning, and hello also to those who are joining us online. It is my pleasure to introduce to you today Professor Christiane Baumeister, who is going to deliver the keynote speech in our inflation conference today on the topic of oil inflation expectations and households characteristics. So Professor Baumeister is the Lambert Family Professor in Economics, and she's a professor and associate chair at the University of Notre Dame. She is also the associate editor of top economic journals, just to name a few: Journal of Monetary Economics, International Journal of Forecasting, and soon also the American Economic Review. Professor Baumeister has a long list of publications in top journals with major contributions in the field of econometrics, but also more specifically in how we think about the link between energy prices and economic outcomes. And her latest research takes a deep dive into what drives inflation expectations, which is a key topic for us as central bankers, but for economists in general as well. This is going to be the topic of her lecture today. Thank you very much for accepting our invitation. Professor Baumeister, the floor is yours. Thank you.
Okay, well, thank you so much, Elena, for the welcome and the introduction, and thanks also for the invitation to present this paper here today. It's a great pleasure to be here, and I'm excited to tell you about the work that I've recently been doing with a very talented PhD student of mine, Pascal Frank. And as well Florian Huber and Gary Koop. So it should come as no surprise that understanding how macro shocks impact microeconomic units such as households and firms using vector autoregressive models has recently gained popularity. And the reason is that macro shocks such as monetary policy interventions, tax changes, or unexpected fluctuations in oil prices do not affect all economic agents uniformly. In fact, effects can vary quite substantially across different segments of the economy or individuals that belong to a particular population, which then results in distributional effects. And this new paradigm calls for econometric methods that allow us to quantify the heterogeneous responses at the micro level and then study the distributional consequences once we aggregate them up again and map them back to the macro level. And there are a couple of approaches out there that kind of use unit level data, among which probably functional VARs are best known by now, but this is a very active area of research currently. Now, another very relevant aspect of the transmission of aggregate shocks that has received a lot of attention lately, and that, however, none of these existing approaches takes into account, is the presence of asymmetries in the sign and the size of these aggregate shocks, various forms of state dependence, and other types of nonlinearities. So what we do in this paper is to develop a flexible modeling framework that brings together these two aspects. So heterogeneity at the micro level on the one hand, and nonlinearities in the macro to micro propagation of shocks. And so we propose what we call a nonlinear heterogeneous agent VAR model that in a nutshell integrates multivariate time series models with nonlinear dynamic panel models where the nonlinearities are inferred based on Bayesian machine learning techniques. And a very neat aspect of that framework really is that we can incorporate characteristics of those microunits directly into the estimation. And that means that we can then classify the results based on specific attributes of these units, which also will help us with economic interpretation. Now, we then apply this framework to address the long-standing question of the effects of oil supply shocks on household formation of inflation expectations, which again has received attention during the recent inflation surge and the supply disruptions that happened as a result of the Russian invasion of Ukraine. And so what we do is we examine whether households react heterogeneously to shocks of different sign and different size, and whether this heterogeneity that we observe in the strength and the persistence of the responses depends on particular socioeconomic characteristics such as gender, age, income, you name it. Now, there exists a literature that has investigated the asymmetric effects of oil price shocks on economic activity that was started by Hamilton in 1996, and also on inflation with a recent contribution by some of our hosts here, Elena, Sarah, and Catalina, together with Florian Huber. Now, there's also evidence that inflation expectations are sensitive to energy price shocks. But quite little is known actually about how the dynamic adjustment in response to these shocks depends on household characteristics and what role nonlinearities play in that kind of setting. Now, central banks often follow the prescription to look through energy price shocks, but of course, once these energy price shocks affect inflation expectations in a heterogeneous and potentially asymmetric way, then they cannot ignore these effects, given that inflation expectations play a key role in forming monetary policy decisions. So that's in a nutshell what we're after here. So what I'm going to do now is to introduce to you the novel modeling framework that we developed for answering this question. Then I'm going to describe the survey data to you, and then I'm going to show you a set of empirical results that we can derive based on this model. Okay, so here is the basic nonlinear Havar model, which tries to capture the interactions between a set of macroeconomic aggregates, which are contained in our vector YT here, and a dynamic panel that consists of n units, be it households, firms, or any other micro level units that you can that you have data for, basically. Now, the model is composed of two blocks that interact with each other. So the first part really describes the macroeconomic dynamics here. So it's a structural VAR model, which is kind of like a pretty standard and empirical macro. So here, that's your standard structural VAR model, which we augment with this part here that captures the feedback effects from the micro level to the macro level. Here we're gonna describe that as the, or we kind of capture that through the inclusion of quantiles of the cross-sectional distributions. But this is just one form that this feedback effect can take. So any nonlinear function of the cross-sectional distribution can capture this interrelationship here. So you could think of other parametric measures coming from the microblock. You could capture the disagreement or any higher moments of this cross-sectional distribution here. Now, the second block describes the microdynamics, which here follow an AR1 process. And then here is the linkage with the macro block. So here we have this function fx, which is unknown. So it captures the relationship of how the information in the macroeconomic aggregates feeds into the decisions by the micro units, or how it influences the formation of inflation expectations in our application later on. Now, in addition to past dynamics of the macroeconomic aggregates here captured by yt to yt minus p, which I denote in a compact way as wt, we also gonna include unit-specific characteristics zi here, that it will become clear in a moment why this is useful. So we have these two blocks to the model that interact with each other in a dynamic way. Now, the key question is, of course, well, what kind of like functional form this relationship between our micro units and the macro dynamics should take. One option here would be to impose some parametric assumptions. In the simplest case, I'll postulate a linear relationship between the macroeconomy and the individual units, but that has the implication that shocks to yt, so aggregate shocks, would have proportional effects on our micro units, and that might be undesirable because, as I said before, we're interested in really studying asymmetries in the sign and the size of the shock. Now, alternatively, to get at that, we could use a nonlinear specification, but that would require us to take a stance on which functional form f of x should take. And it's actually hard to come up with a justification for what kind of like how for a specific form of how to think about this this nonlinearity at the micro level. And of course, if we kind of like get the functional form wrong, then that risks issues of model misspecification. So that's why we decided to basically approach the problem in a non-parametric way and treat f of x as an unknown function and estimate it. And in order to do that, we're gonna exploit machine learning methods. And there's a variety of possibilities out there on which you can draw. So you can, for example, use Gaussian processes or neural networks. But what we're going to do in the empirical application is to use Bayesian additive regression trees, which have been shown to have desirable empirical properties and to work well in the type of context that we're interested in. However, even in that case, modeling f of x in an unrestricted way is not only computationally very demanding, but it can also be challenging from a statistical point of view if we are in a setting where both n, so our cross-sectional units, and t, the time series dimension, are large. Now, in order to make this problem tractable, we offer a novel solution by drawing on some insights from the finance literature here in order to introduce some additional restrictions. In fact, what we do is we're going to assume a factor structure in xt where the factor loadings are a function of these unit characteristics of the micro level information here. So that results in a semi-parametric specification where Qt is essentially the factor that summarizes the aggregate dynamics, but evolves according to an unknown function that uses the macroeconomic dynamics or the macroeconomic aggregates as an input. And then this gamma parameter here are the factor loadings associated with Q. And then by adding in the characteristic Zi, we're going to get individual specific sensitivities to those macroeconomic aggregates, to the macroeconomic shocks. Now, we then gonna, as I said, infer this unknown function mu here using Bayesian additive regression trees. But in the interest of time, I'm not gonna go into the technical details. We can talk about that later on if there are questions about that. Okay, so let me just summarize or highlight the key features of the model here. So we allow basically for different sources of asymmetries here. One are the unit-specific characteristics, which allow us to take cross-sectional heterogeneity into account. Then we're going to account for asymmetry in both the sign and the magnitude of the structural shock. So that allows us to study the nonlinear effects of macro shocks on the micro units. And then given that this is a nonlinear model, it also means that we can or that the initial conditions matter. So the point in time when the shock hits, what is the economic environment, that also matters for the propagation. Okay, so maybe one important point also relative to the existing literature that has tried to take or to model unit level data is that with our framework, we can consistently produce two types of nonlinear impulse responses, namely at the unit level. So we can look at how each individual unit responds to an aggregate shock, but we can also study the distributional implications. So we can also have impulse responses that describe the distributional effects of the shocks. Okay, so one thing that we haven't talked about yet is, of course, how we're gonna identify the underlying structural relationships of the model here. Now, let me say that the model is very general, and any standard identification strategy can be used to recover the structural form here in the macro block. Now, in our application for the Euro area, we're going to go for a specific identification strategy, which I will talk about in a moment. But let me first tell you about the variables that we include in the macro block. So they're going to be 5 variables. The first one is going to be the oil supply shock that coming from the global oil market model that Jim and I developed in our earlier work. We're going to include the real price of Brent crude oil in log levels. We're going to model the energy component of HICP inflation as an indicator of the current state of the business cycle. We're going to include a measure of consumer confidence. And the reason for this choice is basically that it is in line with the survey data that we're going to use and that I'm going to talk about in a moment. So they're coming from the same source and thus are well aligned with the inflation expectations in the microblock. And then our policy variable is going to be the 3-month Euribor rate that completes the macro block. Now, our sample period runs from January 2004 to December 2024, where the start date is determined by the availability of the micro data. And in order to deal with the COVID period, we're going to follow the approach proposed by Hamilton and downweight the observations during the pandemic. And we are going to account for a full year worth of lags here, given that we're in a monthly setting. Okay, so we're going to basically achieve identification by combining a recursive structure where we order the instrument, which is the oil supply shock first, with sign priors on the vector of structural parameters that describe the contemporaneous relationship between our shock measure and the other endogenous variables. So because we really want to approach this problem coming from a structural perspective, so we want to use all the information that we have available in order to distill the underlying economic structure. Now, here is just a way to think about the matrix of contemporaneous relations. So, as I said, we're going to have sign priors on the elements in the A matrix, which captures the contemporaneous relationships between our variables and the shock measure, and that would be the negative of the alphas that I showed you before here. So maybe just for illustration, take that last equation, right, which would describe the response of the central bank to a supply shock, to a change in oil prices, to changes in energy inflation and the consumer confidence index. And so, for example, we would expect if oil prices go up, then also the interest rate should go up, and that's what's captured here. But note that A is the negative of alpha here, so which means that we would have a negative sign in that position here. And we implement this by using truncated Gaussian distributions. Okay, so let me talk a little bit about the data in our microblock, which are based on the harmonized business and consumer survey provided by the European Commission. This survey follows the structure of a repeated cross-section. And the nice thing about this survey is really that it provides not only qualitative inflation expectations, but quantitative ones, and that it is consistent over the entire Euro area member countries. So what is the survey question? Well, in a first instance, participants are asked about their qualitative inflation expectations, and if they answer that they think or that their inflation expectations have changed, then there's a follow-up question that asks them to indicate by how much they expect consumer prices to go up or down over the next year. Otherwise, if they say inflation expectations, if they say that their inflation expectations have not changed, then the amount is going to be automatically set to zero. So this is a survey that is conducted on a monthly basis and includes around 21,000 participants using a harmonized survey questionnaire and a common timetable. So based on that, we can then construct a pseudo panel of quantitative inflation expectations. Now, what is the pseudo panel? Well, we're going to use demographic data that the survey also collects in order to construct pseudo individuals based on various characteristics. So we're going to use information on income, gender, and age, as well as the nationality, in order to construct 305 pseudo individuals, and that form the micro block of our model. And we're going to compute within each pseudo group the average of their subjective inflation expectations. Now, due to gaps in the data, we're going to focus our analysis on 10 euro area member countries to have a long and complete coverage here. Okay, so given that survey is not that widely used, let me start by illustrating a few features of those data. So here I show you median inflation expectations by various socioeconomic groups, low and high income, male and female, young and old. And the key takeaway here is simply that there is some rich heterogeneity across these various household characteristics, especially when we compare high and low income groups. So inflation expectations do not just differ by the magnitude, but also really by the dynamics across these various characteristics. Now, we can also take a look at the distribution of inflation expectations over time. So here you have at each point in time the full distribution that is implied by the survey data, and you can see that there are important changes over time in the distribution of the monthly inflation expectations as well. Okay, so let's take a look at some of the results here. So let's start with looking at what happens in the macro block. So here you see the dynamic effects of a 2 standard deviation oil supply shock, which induces a 10% increase in the real price of oil. That in turn leads to an immediate increase in the energy component of HICP inflation of 1%, which lines up with the share that energy accounts for in the consumption basket. Now, higher oil prices also lead to a decline in consumer confidence. So we have a decrease in this forward-looking measure of economic activity here. And in response to higher oil prices and inflation and a decrease in economic activity, we observe an increase in the interest rate that kind of like evolves gradually in order to get inflation back to target. Now, what happens at the disaggregated level? Well, let's first take a look at inflation expectations aggregated up to across the pseudo individuals by applying survey and country weights, and let's focus on asymmetries in terms of the sign and the size of the shocks. So here you see the effects of a price increasing supply shock in red and a price decreasing supply shock in green, multiplied by -1 to put them on kind of like to make them comparable, in response to a shock of size 1 standard deviation, 2, 3, and 5, appropriately rescaled so that we can compare those effects. Now, what you see is that oil price increases trigger stronger and more persistent increases in inflation expectations compared to price decreases of a similar magnitude. And actually, the gap widens the larger the shocks get. So once we look at 3 standard deviation or 5 standard deviation shock, which implies a 15% and a 25% oil price change respectively, we see that the asymmetries become much more pronounced. Whereas for smaller shocks, kind of the asymmetries are not that pronounced. Now, what we want to do then, however, is to dig a little deeper and see how we can whether these symmetries also exist at the unit level and whether we find heterogeneity. So we want to address the following 2 key questions. First is the heterogeneity in the reaction of inflation expectations at the micro level, so across our various pseudo individuals, and do these responses differ with respect to the size and the sign of the oil supply shock? So essentially, we want to now look at subgroups that are characterized by different socioeconomic characteristics, and also across countries, and see whether the reactions differ there. So the first 2 dimensions that we're going to look at are basically the country dimension and the income dimension. So here I show you the peak responses by country and by income group for a 2 standard deviation shock, which is a typical sized increase of 10% in the oil price. And here you see that for this smaller type of shock, actually the responses to positive and negative shocks are more or less the mirror image of each other. But what you observe as well is that there is quite a bit of heterogeneity both across countries and across income groups. So typically, low income groups respond more strongly compared to high income groups, and kind of like the countries are ordered also in a decreasing way. But it's not as visible in this setting how much heterogeneity there is across countries and income groups. But once we move to a large oil price shock of a 25% increase or decrease in oil prices, that becomes much more obvious. So here you clearly see that large price increasing shocks lead to a much higher response or adjustment in inflation expectations than the corresponding negative shock, and you also see the heterogeneity much more clearly. But if we were to zoom in this previous graph in the same way, we would actually observe as pronounced a heterogeneity across countries and income groups as here, only the asymmetry is not there. Now, that begs, of course, the question, well, how can we explain these patterns of asymmetries and heterogeneity? And that's the question that I want to turn to next. So one explanation is that the large price increasing shocks are obviously much more costly for households, which forces them to pay more attention to these shocks, because the marginal utility of updating information is much higher in the case of a price increase. So basically, the asymmetry can be traced back to a story of rational attention. So you would be more attentive to large price increasing shocks than price decreasing shocks. Now, what about the heterogeneity at the country level and within income groups? So as we saw, there are pronounced differences along those two dimensions, but how can we rationalize that? Well, the first thing that we are going to investigate is what we refer to static explanation that's related to the structural characteristics of countries or households based on the consumption share of energy across countries and across households. So the energy consumption share basically measures how exposed you are to oil supply shocks, and the idea here is the higher your share of energy in the consumption basket, the larger the adjustment of inflation expectations should be. And this seems to be borne out by the data. So here we're looking at the correlation between the energy weight in the consumption basket across countries and their the median response of that of inflation expectations of that country 1 year after the shock, and you see this positive relationship here. So the higher the consumption share of energy, the more you adjust inflation expectations in response to the oil supply shock. Now, there's also within country differences by income. So lower income households typically spend a larger fraction of their budget on energy, which should make them more sensitive to oil price shocks. And in fact, what we can do is we can break down the evidence that I just showed you by country, also by income groups, and we find basically this positive relationship now also by income group. So low income households here for the case of Slovenia, they adjust their inflation expectations much more than lower and middle income households, and they expect them adjust them more than upper middle income households. And that holds across our set of countries. So here we have a summary table. So the higher the median energy share, the larger the adjustment of inflation expectations. Now, so that's kind of like based on certain characteristics of structural characteristics of either the country or the type of households, but there's also potentially a dynamic explanation that we can give here, because as we saw, an oil supply shock triggers a contractionary monetary policy response, and that would allow us to also explain the patterns that we observed in the responses. So the first channel where the monetary policy response comes into play is that homeowners with mortgages tend to pay closer attention to monetary policy, and they anticipate that tighter policy will actually lead to a decrease in or will dampen the inflationary impact of the shock. And so that means that homeowners with mortgages should react less to oil supply shocks than renters. The second channel where the monetary policy response comes into play is that households that are liquidity constrained tend to be more adversely affected by contractionary monetary policy, making the households more pessimistic and inducing stagflationary correlation beliefs, which means that hand-to-mouth households should react to oil supply shocks more strongly as part of this monetary policy transmission channel. And again, if we look at the data, this is borne out here. So we have a negative correlation between inflation expectations and the share of owners with outstanding mortgages, while we have a positive relationship of hand-to-mouth, the share of hand-to-mouth consumers and their formation of inflation, or the response of inflation expectations to inflation expectations. Okay, so these are two dimensions at the individual level of our micro units. But as I mentioned to you before, we can also look at the distributional implications by constructing density responses. Here we just look essentially at how the density evolves in the presence of the oil supply shock and compare that to the case without the shock. And let me just move right to the plots here. So here you see the median response of the cross-sectional distribution in the case with and without shock. So without shock is the dashed blue line. With the shock, it's the green line. And again, we're looking at the effect of differently sized shocks and the distribution after 1 year after the shock. And as you can see, there are quite, so the larger the shock becomes, the more the distribution here shifts to the left, meaning triggering higher responses compared to the no shock case. But what is particularly interesting here is also that we see a lot of non-linearities in those distributional effects here. Now, in order to get a better sense of how different the adjustment really is, we can also look at differences in distributional responses, which basically tells us how the distribution shifts. So how mass from, in this case, lower inflation expectations shifts to higher inflation expectations. So basically, this is the mass that is subtracted and shifted to higher values here in terms of inflation expectations after a 5 standard deviation shock. And again, here you can clearly see that that the size of the shock matters, so that we have important nonlinearities here as the shock size increases. Now, another thing that we can do based on these distributions that I just showed you, we can also estimate the share of the population whose inflation expectations are shifted above or below a certain threshold. And we think that might be particularly useful for policymakers, depending on what threshold they consider to be important. So what we can do is we can compute both downside or upside probabilities of passing a certain threshold. And again, the differences in inflation expectations then tells us how the overall share in the population shifts in terms of the inflation expectations. And so here for illustration, we look again at an oil price increase of 5 standard deviation or an oil price decrease of the same size for thresholds of inflation of 2%, 5%, and 8%. So what you see here is that after a 5 standard deviation oil supply shock, there is basically zero probability for inflation to fall below 2%, but an increasing share of the population starts expecting inflation to exceed a threshold of 5% over a 1-year horizon, and an even larger share expects inflation to exceed 8% after. So, for example, after 1 year, it's like 21%. And well, we can do the same for oil price decreases. But let me show you one other dimension that we haven't talked about yet. So here we're comparing the density impulse response function, so the distributional shifts for young and old, which is another dimension that kind of like we characterized our pseudo individuals with. And what you see here is that let me focus on the right-hand side directly, where we see the effects of again a large shock. So we see that the younger population, which refers to ages between 16 and 29, respond much more strongly than the older population, which refers to individuals with age above 65. Again, we can capture that in terms of the shifts in the distributional responses. And what stands out here really is that the younger population starts already at a higher level of inflation expectations, and then so shifts from 8% to about 12%, whereas the older population starts out at a lower level, so below 5%, but then in the end exceeds 10%. So we see important shifts in the probability mass here across for older relative to younger individuals. And a potential channel here is that the stronger adjustment among the older individuals, so that they move from a lower level to essentially the almost the same level as the younger individuals, would be consistent with a story of selective memory recall of past experiences, which would lead to a more pronounced belief update. And I believe Raphael is going to tell us more about that later on, and he can also tell me whether that story would make sense here. Okay, so let me just conclude. So, well, there are two key takeaways from this paper. The first one is methodological. So what we did in this paper was to propose a new modeling framework of scalable micro macro interactions that links a standard structural VAR at the macro level with nonlinear dynamic panel with a nonlinear dynamic panel model to capture microdynamics. With this model, we can look at the propagation of micro to macro shocks, allowing, however, for a feedback also of microdynamics into the macro block and potentially altering macrodynamics as a result of this additional information coming from the disaggregated level. And we're particularly interested in the role of nonlinearities in this framework, where we, however, remain agnostic about the type of nonlinearities or the form that these nonlinearities take, and we infer them by using machine learning techniques. Overall, the model is very tractable. Computation is straightforward and fast, thanks to the efficient MCMC sampler that we develop. And we think that this framework lends itself to very many in very many contexts, to many different applications. Now, our particular application here to inflation the role of oil supply shocks for inflation expectations in the euro area yielded a number of new empirical findings. So we showed that oil supply shocks trigger asymmetric and heterogeneous reactions in household inflation expectations. And we saw that oil supply disruptions that lead to a price increase trigger stronger increases in inflation expectations compared to price decreasing shocks. And this asymmetry in the size of in the sign and size of shocks becomes more pronounced. And then we were able to also kind of like, thanks to the household characteristics that our pseudo panel incorporates, we were able to show that lower income households, older individuals, and countries with a larger energy expenditure share display a more pronounced adjustment to oil supply shocks. Thank you so much.
Thank you very much for this insightful keynote lecture. I will open now the floor for questions. We have one there and there.
Good morning. Hi, Christiane. A very nice talk. Nice to meet you. Nice to see you. So this morning we had a little bit of discussion about, in a network, what is more important, the energy or the food? So when I think about inflation expectations on the household side, there's a lot of discussion about the two of them, right? So I think it's a very nice framework. Your BAR, you could exactly do the same, with food. First-man shocks, you put the prices, and then you see how it transmits to the micro. Have you thought about this? This question could help us to see maybe the answer in household inflation expectations, which one of the two are more important. And the second question is related to this one. When you do this, are you not worried that your inflation, your shock, oil shock, is actually also not orthogonal to the food shock? So how could you now distinguish between these two? Thank you.
Thank you. Another question there.
Thank you very much for the presentation. I was wondering, one source of heterogeneity that I would expect for households would be like sources of labor income. How do we think about this in this framework? For example, if some households, not necessarily, well, sometimes maybe the low income ones might be employed in more demand sensitive industries, but I wouldn't think it's just by income decile, but just their sources where what sectors they're employed in. I thought that was an important source of heterogeneity as well. Thanks.
Thank you. Perhaps one related question to this, whether also the level of education could be a source of heterogeneity. The level of education. Thank you. And let me collect 2 more questions, if possible, before I give back the floor to you. There and there.
Okay, hi, thank you so much. I wonder, what is your view on whether the results also generalize to energy shocks in general, not only stemming from oil price shocks, because obviously what we've seen in the recent past is not only oil price shocks. So I'd be curious to hear your views on that. Thank you.
So thanks a lot. It's a wonderful, wonderful paper and a wonderful approach. So do you understand it correctly that shocks to expectations affect the macro block only with a lag? So yeah, so Guido will present a paper in the afternoon. I hope it's going to convince you that this might be a too strong assumption.
Thank you very much. Christiane, the floor is yours.
Much for these really useful questions. So let me try to give you a sense of what I think about these various aspects. So yes, food inflation, of course, is also, or kind of like food prices and the effect on inflation expectations. It's like, I mean, food and oil prices are both very visible to households, right? So because they're exposed to it by shopping, essentially, right? So this is also what this earlier literature said, why inflation expectations are so sensitive to energy price shocks, right? Because we see them basically on a regular basis by just driving around. Same with food prices, of course, if we do grocery shopping. So yes, I would kind of like expect there to be effects on inflation expectations also coming from food price shocks, right? But maybe one distinguishing feature, and that came up in the discussion also earlier this morning, is that food price shocks in a way are smaller and they are more dispersed, right? So it depends really on what type of food items you have in your consumption basket. Whereas, I mean, gasoline prices, which are directly related to oil prices, right? So is maybe a more homogeneous good, and we see larger spikes. Moreover, I mean, you could also think that there's a relation because you need energy in the production of food, right? So in that sense, these two, there's a relation between the commodities as well. Now, of course, if you would want to identify both food price shocks and energy price shocks in the same model, right, you would have to make additional assumptions in order to be able to disentangle kind of like, or to call them structural in some way, which I guess you could do. I mean, as I said, the framework in and of itself, you can use any identification strategy that has been used, but you need to make additional assumptions, of course, for identification in that case, right? And again, just to drive home, I think, yeah, food prices and shocks there are important, but again, they're less tangible sometimes. So, I mean, we read about oil supply disruptions in relation to wars, geopolitics, whatever, kind of like very frequently, whereas food prices, right, or food price shocks are not as much discussed, I guess, unless you have like a bad harvest, or what was discussed like in last year a lot, like egg prices, right? So there was all of a sudden this egg crisis. But I think these things happen more sporadically and in very specific food items. Now the question about the sources of income, yes, that's, I mean, I wish we could distinguish between that, but the survey only gives us information about the various buckets of low, middle, and high income. But I mean, conventional wisdom tells us usually that low-income households are deriving, or their main source of income is from labor, right? So whereas high income probably has a more diversified sources, but we cannot. I mean, we don't have that information in the data. So I wish we would. So that would be an interesting distinction to make. Then Elena's question about education. We have information about education in the survey, and we could use it as an additional kind of like way to come up with pseudo individuals. But then again, education tends to be highly correlated with income. So that's why we didn't think that there was a lot of independent information in the education dimension per se. So that's why we decided to go with income. But again, if there are other questions and you want to use that survey, you could. So it's really up to you, kind of what characteristics you want to exploit in constructing the pseudo individuals. Now there was this question about energy shocks in general, right? Sure. I mean, you could also, if you have a way to define these shocks or measure the shocks, right? So then it's a little bit like with food price shocks. You could, of course, look at other shocks. Now, again, given the tight relationship between oil prices and gasoline, and given that we're still mostly driving on gasoline, I think this accounts for the largest share. In fact, if you look at the breakdown of energy in the HICP, most of the time the component that moves most is actually gasoline. Only in the most recent event of the Russian invasion of Ukraine, right? You also see kind of like electricity prices move a lot as a result of the stop of natural gas imports. Now, yes, the question about inflation expectations from the microblock entering with a lag, right? So, I mean, 2 points there. I mean, one is an econometric issue, right? So you would have an identification problem if inflation expectations were to feed back into the macro block contemporaneously. I'm not saying it cannot be addressed, right? So potentially you could come up with a way to account for this contemporaneous feedback effect. But there's an economic reason why we haven't done that. And I'm kind of like now very intrigued by what you're going to tell us later today. But so given that it is, I mean, that it is the effect of the individuals on the macro block, right? So it's sort of the smaller units affecting or having an influence on the aggregate dynamics, right? So we thought it's reasonable to assume that there is at least a lag of a month before that happens, but I'm happy to be convinced otherwise.
Thank you very much for the great keynote lecture. Let's give a round of applause to Christiane Baumeister.